Hi there. Thanks for tuning in. Today, we're going to be doing an analysis and valuation of Interpublic group of companies. They're essentially one of the big 5 marketing services firms, along with Omnicom Group and a couple of other companies. So, let's take a look at Interpublic, and I frankly just want to jump straight into their financials. I want to make this a slightly quicker video than usual, so let's talk about it. So, as you'll see, we have 3 columns here starting 2020, 2021, and 2022. Their total revenue has been increasing, but their operating income has not been, or that's not the story, at least from 21 to 22. And their net income from 21 to 22 also suffered a little bit. Obviously, 2020 was a very different year, so we can't necessarily say that there's been a huge improvement here, but from 21 to 22, they definitely saw a little bit of a downturn. And you'll see that they also had some big restructuring that probably happened from 21 to 22, so that has added on to the expenses a little bit. But it's important to put this into context. If you go to their investor presentation, they talk about how their restructuring, which has been 4% of revenue in the 3 months ended December 31 of 2022 as opposed to 2021, you'll see their restructuring changes jumped up. And likewise, every other expense jumped down, right? So it seems, based on this investor presentation, which is for the full year of 2022, with these quarterly results compared with the previous year, that their restructuring is taking up money, but is helping them drive down costs. Almost all of these costs of the operating expenses are down, right? Salaries, instead of being 62.2% of revenue, are 61% of revenue. But if you look at the latest quarterly report, which is Q2 of 2023, you'll see a different story. Now the restructuring changes are gone, and the salaries are up as a percentage of revenue, although some other expenses are basically down or flat. So what does this mean? This essentially means that it may be a little bit soon to tell whether or not the restructuring has actually brought down their fixed costs and their operating expenses, but this is something worth keeping track of. If you're an owner of this company, you will want to know how this restructuring is going to affect them in the future. They seem to be doing these efforts to cut their costs down, but will they work, and will they work effectively in the long run? Well, you have to be willing to track this, right? And I also want to talk quickly about their free cash flow, because their free cash flow is down considerably from 21 to 22. This is something that didn't really happen before in 21, and in 2020, 2019, 2018, all these years seem to have a pretty consistent free cash flow. You can see here cash from operations that was about $2 billion, capital expenditures about $200 million, which stayed relatively the same, even went down a little bit in 22. But the difference here is that cash from operations was actually $608.8 million in 22, so down significantly. Part of this is because of change in working capital. These can be one-time expenses. They may have, for example, been deferring payment to some of their suppliers, right? They're saying, we'll pay later. So in this year, in 21, this may seem positive because this is cash they have right now, but this may be negative now because they paid later, right? So these may be one-time things. These may be fluctuations, but they do have lower free cash flow now. So it's important to take into account, because a lot of their operational efficiency, if we're forecasting, is going to depend on whether or not they can get back to those old levels of 21, 2020, 2019, etc. You will also note from the cash flow statement that they do put a lot of money into the dividends and the repurchasing of stock, right? So in 22, they put more money than they actually had free cash flow into dividends and stock buybacks. So that's important, because it means that they are giving back money to shareholders, right? And likewise, we can see that there is a change in the cash money that they have available, but they still have a little bit more compared to the previous years, right? So I want to do a discounted cash flow model using sort of a midterm prediction, right? Before, their free cash flow was about $1.88 billion, right? Then it went all the way down to $430 million. It's likely that it's going to recover. This number is not going to hold forever, this lower number. But I don't want to say that they're going to recover immediately, right? Before, about 20% of revenue got translated into free cash flow. I'm now going to say a number between 13 and 15% of revenue will get translated into free cash flow, just to be a little more realistic. And I am also just going to say that they're going to grow their revenues by about 2% per year, right? And I am going to also make this the perpetual growth rate. They're going to grow 2% per year in perpetuity, right? That's how much the world economy will grow, roughly. I'm also going to ask for an 11% rate of return. This is 1% per year more than the market on average. So I think this is a fair rate of return to ask. And if we put this in a discounted cash flow model, which you can see right here, divided by the total number of shares, I get a fair value for Interpublic Group of Companies for $38.41. But we have to subtract the net debt from it. So they do have debt. They have about $3 billion in debt. So if we subtract the net debt, then we end up with a fair value post-debt of $30.55 for Interpublic Group of Companies. Now let's see where the stock price is at. So Interpublic Group seems to have taken a tumble recently in terms of price, right? They were trading around $40, tumbled recently to that 33.3 that you're seeing right now. However, it seems that they've been way lower before. This is actually a high in relation to the last 5 years, that is. But in relation to the fair value, well, it is a little bit over the fair value I got, but not significantly so. So I wouldn't be too surprised to actually see it dip below fair value. It clearly did right before 2023 started. So it's possible. It's possible to find it at a good price according to my quantitative model, right? Do we want this good price? Well, that is up to you. But clearly it has been lower before. It may be lower again. Or if your calculations are different than mine, if you think they'll grow quicker, or if you think they'll pay down a lot of debt very quick, then maybe you're comfortable with a higher price for it, right? So let's talk a little bit about risks and rewards to see if this stock is worth owning. So Interpublic Group does have at least 4 other formidable competitors. It's one of the big 5 marketing firms and many other smaller ones. So they have relatively little moat in terms of their competitive advantage. Now, a global economic downturn will severely hinder Interpublic Group's performance, right? Marketing, this is something that a lot of people will cut expenses on if all of a sudden their survival is sort of threatened, right, by a global economic downturn. A lot of businesses will still need to pay rent, but they will not necessarily need to pay a marketing firm. So they can just cut that expense, and that's at the expense of Interpublic Group or other similar firms. Lower free cash flow, if sustained, can result in lower shareholder returns as well, right? If they have lower free cash flow, if they have less cash money to work with, they have less cash to pay down debt, to give dividends, so there may be less dividend raises if you're a dividend investor and less dividend growth rate. There may be less share buybacks. So the total shareholder returns, even though this is a company that likes returning to shareholders, may be less. Now, this is still a company with consistent growth in the top and the bottom line, right? The top line seems to be growing very consistently. They seem to be making more and more revenue every single year. And the bottom line, their net income, is also very consistent. The only thing that hasn't been too consistent has been free cash flow, and that is solely in the year 2022. And they do have some restructuring that should cut down fixed costs. We'll see if that is true or not, but at least they seem to be putting a lot of effort into it and a lot of emphasis into it. They also have a solid dividend, right? It's almost 4%, coupled with share buybacks. That means that returning money to shareholders is a priority. We love seeing a company that likes to return money to shareholders. So with this balance of risks and rewards, I can tell you that sometimes it's worth waiting for a great price, right? Maybe the risks will be outweighed by the rewards when you're getting in at the right price, and the chances of the risks severely affecting the stock price are not as severe, right? If a stock is already almost down to the floor, but there's a lot of potential rewards, well, a risk cannot bring the stock that much further down, but the rewards can bring it significantly up. So sometimes with companies like Interpublic Group, and you see that they have had great price fluctuations in the last 5 years, it's worth waiting for a great price. Now, I hope you enjoyed this short video. If there's any company you want me to analyze, please comment down below. I would love to read your comments. And with that said, please like and subscribe if you liked the video, and I hope you have a great rest of your day.